Have you been caught on the backside of a real bad loser? Well, I certainly have. Let's have a discussion.
Wait. Matron, take them away. Oh.
And a warm welcome to one and all. If this is your first time here, I am the big fella. That is the Scruffy Trader. What I'm trying to do is put trading in the real world. Maybe show you a trick or two along the way. So if that sounds good, do take a second to hit that little subscribe button. Genuinely helps, as does smashing the like and super thanks. So losses. We all occur them. Now, the problem with losses is if they're controlled, it's not really an issue. If they get let to run out of hand, then it becomes a real problem. So I just want to spend a minute or two talking about the mindset of losses and basically the mindset of trading in general, because so much is spouted about the industry and the flashing lights that you kind of lose the process in the process of selling in a roundabout way, if that makes sense. Certainly when you see sort of the Instagram post, if you like,
make it stop.
You know, what I call the land of make-believe, because it is. It's absolute bullshit, most of it.
These guys, they're fucking idiots.
You know, and the clowns that are on there saying, oh, give me your money and I'll trade for you. Well, you'll give them the money. You'll never see it again. That's a loss. But that's a loss through stupidity. Because if you're dumb enough to believe the crap that's spouted, then you probably deserve to lose the money in the first place. But what if you're trading? What if you're a trader and you take a big loss? What is that? Is that stupidity? Is it bad education? Or is it emotion? Well, it could be all three, to be honest. Stupidity is the easiest one in the world to fix. You know, if you put on a trade and you, for argument's sake, have a stop loss that's either miles away or not in place in the first place, and you've got a position that's too big, but you know you're doing it at the point of entry, that is stupid. And it is stupidity. And how do I know that? Because I've done it. The worst loss I ever had wiped out best part of 18 months of work. All right, I built the account up and I was feeding into it. But it was the thick end of 18 grand in 4 days. Right? Why? Because I thought I knew better. I was arrogant. And I put a position size that was too big in a market that was way too volatile, the DAX. Went away for a couple of days without a stop loss. And when I came back, I was wrong. And not only was I wrong, I paid for it heavily because it just wiped the account out. So that was stupid. But what lessons did I learn from that? Well, I recognized that my arrogance and my desire to win was working against me. So from that moment, I had to step back and think about what I was doing. Now, the emotional impact to me at the time was huge. In fact, it was so big, I couldn't really touch the keyboard properly for about a month, certainly 3 weeks, because I was snakebite fearful of it. I felt ashamed. And shame is a terrible thing because that makes you do silly things. I didn't really want to talk about it when I should have done. So I bottled it in. That bottled inside of me created anger because I lost a lot of money. You know, and I pointed the finger at everybody but myself. But I couldn't do that in hindsight because they didn't press the button. And it doesn't matter what the education is. if you press the button, whether it's from a signal, whether it's from your own analysis, or even just on the flick of a coin, but if you press that button, the onus is on you. But we're in a culture, and as human beings, we look for fault. And that fault can be channeled in different ways. And if it's anger, it's murder, because you can start an argument when you don't really want to. You know, you're just frustrated, you're trying to get that out. So you need to curb that. Now, the other side of it as well is fear, because then you become frightened of this. Not only are you angry, shameful, all that sort of thing, you're fearful as well. And fear is quite a bad one as well, because not only are you frightened of the keyboard, you're frightened of your own analysis. Even if you think it's right, you will still be frightened of it. So you'll sort of tinker with the way you would normally trade. In other words, you'll start system hopping, or you'll think, oh, well, I can't do that, so I'll pull my stop in because then I won't lose as much money. Well, it's all counterintuitive, because if you're changing your system, well, you're now into a new territory and you don't understand it fully, so you've got to go through all that again. So that's going to make you lose. If you pull your stop in too tight, well, the market's going to take it off you, so that's going to make you lose. And all of these things start weighing on your shoulders, and it doesn't ease the pressure. It actually makes it worse. And then you get yourself into a sort of like a cycle of the markets are rigged, everything's against me, all of this sort of rubbish. They're not. It's actually yourself. You are what's causing the problem. So how do you get through it? And we've all done it. We've all done this. And this is like a salute to a couple of guys in the squad who've been through it. I'll not name them because I don't think you should pull them out this time. But let's put it this way. They're good guys. They know what they're doing. And sometimes you just need a little person to sit next to you and say, this is the way. All right. So I'll shout you in the Discord, but this is for you guys, okay? Right. First thing you do, all right? First thing, if you've had a big loss, and I mean, I'm not talking like 100 quid. I'm talking like where you lose something that will really shake you, right? You know, like 1,000 quid. 1,000 quid is a lot to lose in a trade, especially if you've only got a small account, because you've got a $5 grand account. You lose £1,000 of it, that's a colossal blow. You have a £100,000 account, you lose 1,000, so what, right? So it's horses for courses. So it's something that affects you significantly that you can see, all right? So that gets that under the table. So what's the first thing you do? You take a day off, all right? 1 day, minimum. You don't even switch the screens on, nothing. You don't look at any charts. You do not read anything about trading. You take an entire day off. Grab a coffee, grab a beer, take your missus out for a meal, or your other half if you're a lady. But take a day off. If it's a colossal loss, take a week off. Why? Because what you're trying to do is calm the emotional context of your own self down, all right? And if it's out of sight, it's out of mind, as the old saying goes. Now, we are going to revisit it, but you need to revisit it with clean, fresh eyes. And if you haven't got those clean, fresh eyes, every time you see the chart, the anger side's going to come out, the fear side's going to come out, the shame's going to come out, and they're all going to run together, and you will be blinded by the chart. Worst thing you can do. So step out of it. Right. Have a break. You've had your break. Come to the chart with clean eyes, cup of coffee, drink, whatever, because you're not going to be trading on the next day either. All right. What you're going to be doing now is writing down what went wrong. Journal. Write it down fully. Boom, 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 with a clean mind. And then what you do is you open the chart up after you've wrote it down. And there is method in the madness here, guys. Writing it down before you open the chart. Because once it's in front of you as notes, you can then revisit where this trade went catastrophically wrong. And actually see if the chart is marrying up to your thoughts that you've just wrote down. Why is that important? Because what you think you've done and what actually happened could be two different things. Because the mind can play tricks on you. It genuinely can. All right. So if they are conflicting, you know, you could say, well, I was getting in because there was a stretch of the Bollinger Band. I hit a level. I was doing this and I expected it to bounce here because that's where I thought the stop was be. But I moved the stop further on because I was dumb and all this sort of thing. But then you find out that those conditions weren't there at all. You took a punt and you paid heavily for it. But you could have convinced yourself that you were getting into the trade. Now, what you're trying to do is marry up a certain set of criteria with another set of criteria. A little bit like Winky here. She tries to marry up and do silly things all the time.
Like what?
Well, what do you mean, like what?
What do I know? That's silly.
You married me for a start. but that's what you do, all right? So what you're actually doing at this point is you are not only analysing the chart and the criteria of what went wrong, you're also analysing your own psychological assessment of the situation, okay? And that's a big thing. And that's why when you see my journal, I have a section in that says, what's my mood? Because if I did go to the market angry, I could be looking at something that isn't there, but I believe it's there because I kind of talk myself into it because I want this. And you need to do that. So step out of it. Write it down before you open the chart. Then open the chart and see if it marries. So there's some good tips for you to help. But then when you do go back to the market, you are going to be snakebite fearful. So if you were trading at £2 a point for the next 2 trades, or the next 2 days even, trade at half your position size. All right? Boom. That'll help build your confidence. And if it does go wrong, the numbers aren't as bad as what they were before. So this helps you. When it comes to your stop placement, work your stop out before you work your profit out. So look at where you think you're getting in. Could be a level, bounce off a moving average, whatever it happens to be. But the area on the chart where you think that you're going to get in, draw a line on it. Look at where your stop is going to be, down here, if it's going long sort of thing. Draw a line on it. Measure the distance between the two and work out the monetary cost of that stop. Not how many pips, nothing like that, but where the stop should be hidden, and work out the distance. So if it's 100 pips for argument's sake, you're £1 a pip, that's going to cost you £100. If you are frightened of that number, half the position size, but leave the stop where it is, because the stop has to be where the stop has to be, and the stop has to be at the point of no return. And the point of no return is very simple. That is where you've had enough, it's going to cost too much to the account, you do not take any further than that. And if you get clipped, you get clipped. But if you understood how much it cost before you press the button, well, then you're at peace, and this calms your mind down for the next trade. And then your profit is just whatever the target is on the other side. Okay? Don't get too hung up on risk reward. It has its place, but it can force you into a losing trade. It genuinely can, because you'll be trying to get these stupid numbers that some people click about. You know, when they go 1 to 2, 1 to 3, I go with. When you go sort of 1 to 5, 1 to 10, 1 to 20, they are very rare. They are really rare. And I don't know many people that does this for a living that hits them. In fact, I don't know any. So that might help you. But start 1 to 1. Then you're 50-50. maybe it's 1 to 1.5, then the edge, and then work out and build up your charts logically, and you'll find it's easier. Next part, do not, and I really mean this, do not change your system. If you've had a system that works and you understand it and it's been working, but then it clipped you, it's just one of them things, guys. But if you start chopping and changing, you'll find yourself, well, you just get yourself on a treadmill of terror. You'll just be going around in circles all the time. And then finally, if you were taking 4 trades in a day, curb it to 2. Half whatever the amount of trades you're doing. And ideally, curb it to 1. And I have mentioned the 30-day challenge before. It is a great psychological challenge, and it's a great way to try and sort of build your confidence, build an account, but also slow you down, which is the best thing. And that challenge is you trade once a day for 30 days. And if you are positive at the end of it, you can either increase your position size, or if you're looking to go to a prop fund or something like that, maybe take the fund challenge. But if you failed, and you can fail by either having a negative expectancy, or if you traded more than once a day, because you might see another set and go, oh, I think I'll just take that one. So you traded twice in that day, you fail. And why did you fail? Because you let emotions take over. You should be detached from the screen. My job is one trade. Get positive, stop, do it again the next time. If I do it twice, I've put the account at risk. I could hit big stops. No, you fail. And then if you fail, you do it again till it teaches you. So just something for you to think about, guys. I do cherish your comments. Drop it down below. I answer every single one of them. And if you want to contact me, all my details are in the description. And there is details of the Scruffy Squad as well, where I'm there every day showing you trades in the moment. So as always, guys, trade well, keep your risk managed, but above all, do what you love, and the money will follow. See you all in the next one.